Sam Altman said, AI is the most important thing to happen in a long time, and yes, investors are getting overexcited. Over $25 billion flowed into AI startups in the last quarter alone. That's the numbers the headlines carry. But headlines hide the truth about concentration. Only a few massive rounds drove most of that number, including checks over $500,000, like Magic's $500 million raise announced without any revenue. The numbers look incredible. Record funding round, billion-dollar valuation, waiting lists for GPUs, and the list goes on. But behind those headlines, investors are whispering a familiar word again: bubble. We've seen this pattern before and numerous times in history. The dot-com boom, the crypto frenzy, even railroads and telecom in earlier centuries. Every generation finds its own version of irrational optimism. The question here isn't whether or not AI is transformative. It obviously is. The question is, are we paying today for a value that won't exist for the next 10 years? In this video, we'll have a look at what the smartest investors in the room are saying about this moment and why some believe we're repeating history even faster than ever before. Before we get started, I publish a new video every week, so please, if you don't want to miss any of them, consider subscribing. Thank you so much. My goal here is not to talk down innovation or to predict a crash. My goal is to understand where in the cycle we're in, particularly where capital, technology, and human psychology all collide. So let's explore together how bubbles form around real technologies and why investors are pouring hundreds of billions of dollars into AI infrastructure. I also want to show you about the warning signs are really appearing in the data, and finally, what founders and investors can do to stay on the right side of history. Let's dive in. If you've been anywhere near venture capital this year, you've seen the rush. Every week, there's a new AI company announcing a massive funding round. Mistral, Anthropic, XAI, OpenAI, obviously, $500 million here, $1 billion there, some with products barely in beta. Others with nothing more than a founding team and an angle. What's going on here? Well, when you take a closer look, you'll see it is easy to understand why this is happening. OpenAI showed the world that it was possible, and now everyone wants to own a piece of that future. Because of constraints in production, investors started treating compute like beachfront real estate. By now, before it's all gone. Founders who once pitched AI-assisted are now rebranding entire products around AI as the product itself. And, of course, terms like AGI, inference, and copilot are thrown into decks, whether they fit there or not. Everyone's chasing an OpenAI multiple without OpenAI's moat. A few platform winners capture disproportionate economics, OpenAI and major cloud providers, while the rest compete for leftover margins. The result? Startups raising at sky-high valuations, often 3 years ahead of actual revenue. A founder who raised $10 million to build an AI-powered recruiting tool said their biggest expense is GPUs and their second biggest is marketing. And 12 months later, they still struggle to find paying customers. You will find numerous companies raising hundreds of millions of dollars on product roadmaps rather than on sales. I've mentioned Magic's $5 million round. There's also Adept or Character AI at pre-seed. These are the kinds of capital events that fuel optimism and, at times, unrealistic pacing. An MIT study shows only 1 in 20 AI pilots produces measurable ROI. This story is playing out across dozens of companies right now, the natural consequence of easy money and collective excitement. Everyone wants to have an AI strategy, they implement stuff just for the sake of implementing, and the results are not here. And that's exactly how bubbles form, when great ideas meet bad discipline. To really understand what's happening, you have to look beneath the headlines, at the mechanics of capital flow. Investors are underwriting roughly $600 billion of AI infrastructure build-out between now and 2026, while measured revenue today remains a fraction of that. This is what David Kans calls the AI $600 billion question. The capex required implies much higher monetization than we can currently see. And yet, most of the revenue still goes to just one company, OpenAI. Worse, empirical signals warn us the infrastructure isn't being absorbed quickly. Investors call it building the railroads for the future, but some say the tracks are rusting before the train even arrives. The infrastructure build-out has become a race in itself. Every hyperscaler is competing for dominance in compute. Nvidia obviously sells every chip it can make. Microsoft, Google, and Amazon are building new server farms at a pace that dwarfs anything since the telecom boom. Yet, for all of that investment, enterprise adoption is lagging. Most corporate AI projects are still in pilot phase. Newer chips and cheaper cloud instances will commoditize margins. What's premium this year can look like a commodity next year. In short, hardware is not a perpetual moat, it's an asset that depreciates rapidly. That's why companies like Nvidia, AWS, and others are the predictable winners in this phase, because they sell the tools everyone needs. But it's just a phase. The B100 surge is a concrete example. Hardware demand spikes, stock and pricing respond, and profits accrue to the infrastructure vendors, not necessarily to small AI resellers. That mismatch between capital expenditure and economic output, real problem being solved, generating income, is what defines a bubble. And again, it's not because the technology isn't real. It very much is. It's because the price we're paying today for the future potential has detached from present value. In this sense, the current moment mirrors the dot-com era. The internet was obviously revolutionary, but in 1999, investors priced in 2010 profits. The same thing is happening now. Everyone knows AI will change everything, but not everyone can wait for 10 years for those returns. As liquidity tightens and rates stay high, that impatience creates fragility. This creates a feedback loop. Valuations rise, fear of missing out intensifies, capital chooses momentum instead of merit. And as always, when pricing outpaces progress, correction is inevitable. If you've been investing long enough, you start to recognize the sign of a bubble, because bubbles follow a pattern. And this is not just in markets, but in human behavior too. Phase 1 is discovery. A breakthrough captures imagination. The internet, crypto, AI, and the early adopters move fast and build real value. Phase 2 is imitation. More money chases fewer ideas. Valuation inflates, copycats flood in, founders start to raise capital not to grow, but to signal they're winning and to market capture. Phase 3 is disillusion. Reality catches up, adoption slows, burn rates climb, and investors quietly stop returning calls. And finally, phase 4 is renewal. The noise clears, leaving behind real companies solving real problems. The correction happens, but it doesn't destroy the industry, but rather it disinfects it of all the useless companies and investors for that matter. Corrections don't destroy industries, they separate signal from noise. So how do you stay on the right side of that divide? The smartest investors are looking for defensible IP and betting on pick and shovels. History has shown that in every rush, the sellers of infrastructure make the most consistent money. During the dot-com bubble, it wasn't the websites that survived. It was the companies building the routers and the servers to power them. During the crypto run, it wasn't the coins, it was the exchanges and custody services. In this cycle, the equivalent has been Nvidia, AWS, and Databricks, the companies selling compute, chips, and the data infrastructure to everyone else. When valuations run ahead of reality, it becomes harder to stay disciplined. You raise too much, too soon, and build features no one asked for. When capital is abundant, discipline is rare. The founders who will survive the coming correction are the ones anchoring valuation to fundamentals. The ones that can show clear ROI, unit economics, and burn rate under control. Because when this wave cools, capital will flow not to hype, but to evidence. And those prepared for that shift will find themselves in a stronger position than ever. The irony is that most people forget. Every major innovation cycle looks like a bubble before it becomes normal. The railroad mania of the 1800s left half its investors broke, but it built the transportation grid that powered the industrial age. The dot-com crash of the early thousands wiped out trillions, but the same fiber networks now carry the entire internet. Even the crypto winter, for all its chaos and disappointment, forced builders to stop chasing token prices and start solving real infrastructure problems. That's how progress works. Bubbles are how society funds infrastructure. The AI boom will be no different. Yes, some valuations will fall, some startups will disappear, but the capabilities being built right now, the chips, the models, the data pipelines will become the foundation of the next decades of growth. So as capital tightens and headlines turn skeptical, remember this: the real opportunity is never in the mania, it's in the rebuilding that follows. Thank you for watching. Please consider subscribing, and I'll see you next week.